Let's now look at the mechanisms in which monetary policy actually works. Remember, we used this term open market operations just now. So when the central bank actually conducts monetary policy, we say that they are actually carrying out open market operations. So what are open market operations? They can be carried out in one of the three following ways. So number one is to change the reserve requirements. What do you mean by change the reserve requirements? So central banks can actually change these reserve requirements that commercial banks they have to hold in their reserves and they cannot lend out. So reserve requirement is basically the minimum that a commercial bank must hold in terms of their reserves of cash. So if they have a higher reserve requirement, the higher the reserve requirement, the lesser a commercial bank is able to actually leave to provide for loanable funds, the use of loanable funds. Now, in the real world, this changing of reserve requirements is a little bit more complicated than that. But today we will not focus so much on the mechanics behind how there is this thing called reserve ratio and how this reserve ratio works in different countries. That's a story for another day. But basically, get this part straight. If you have a higher reserve requirement, that means to say that you actually have less that you're able to lend out. And if you have less that you're able to lend out, then the supply of loanable funds will actually decrease, right? Which will actually raise interest rates. So the higher the reserve requirements, the lesser the supply of loanable funds, and that actually affects interest rates. That's how central banks can use the reserve requirement to affect interest rates. Next, we can change the discount rate. What exactly is the discount rate? So in some countries, central banks they provide funding, loanable funds to commercial banks. So the interest rate that the central bank will charge to commercial banks is called the discount rate. So of course, if the central bank raises the discount rate, it costs more money for commercial banks to borrow from the central bank. Then commercial banks will also correspondingly increase their interest rates, and that is what changing discount rate would do. And lastly, the most important part of open market operation, which is to change the monetary base, is actually what we're really saying when we're saying increase money supply, decrease money supply, is done by the buying and selling of government bonds. So we can change the size of the monetary base by either buying government bonds or selling government bonds for hard currency. So when the central banks go to the open market, they buy up government bonds, so it will result in increase in hard currency available in the economy. But if the government sell government bonds to the open market, it will result in the decrease in hard currency available in the economy.